first presentation, our article on there not being a pop in the stock market bubble. And as we've learned over the past few months is that if things go down, they're very likely to go back up again. So is now a good time for us as investors to start investing in stocks? Last week, I talked extensively about the S&P 500, which I'm showing you guys here again. And as we can see, over the past 2 weeks, the S&P 500 has tapped its support level twice and shot straight back up. So this essentially means that it could be a great place for us to buy, right? Well, unfortunately, not so much. And the inflation and interest rate topics have been going on over the past few weeks equally as they have previously. So it's not really a very secure environment, but let's connect some dots here. Well, through COVID, a lot of governments have actually started printing a lot of money to supply us, the humble citizen, with money to survive the coronavirus crisis and pay our bills. Unfortunately, putting all this money into the system increases the chances of inflation actually happening. Now, additionally, to not have to print as much money, they're trying to make money or receive money by selling bonds. And a bond, in a very short way of explaining it, is an investment type. You give the government a specific amount of money and they'll pay you back in a predetermined amount of time, including interest. So it's a very safe investment vehicle. However, by selling a lot of bonds, the governments are mounting a high amount of debt for the future. Now, what can governments do to stop things going south? Well, a classic way to mitigate inflation or printing a lot of money would be by raising interest rates. Now, raising interest rates isn't a great thing to do because, first of all, companies don't make a whole bunch. They actually don't make as much profit as they would if interest rates stay the same. Additionally, if companies don't make as much profit, they can't pay as much taxes. So without as much tax, governments can't really repay their bonds. So we're kind of in a very, very sticky situation here. And we really want to analyze today what it means that if we do raise interest rates, what it would mean to a company. And this is something that we really that we see across the board. And the companies that are affected the most really are the ones that are running on a loss. I'm just going to show you an example here. So if a company, let's say it's a car maker, has its total revenues that it makes over the course of a year. It makes a whole bunch of money, but to finance making these revenues, it has to take on a whole bunch of debt from, may that be a bank or a loan or a government, whatever it may be. And some companies, believe it or not, they actually have more debt than they have revenues. So they're a loss-making company. Now, if we raise interest rates and companies have to pay more interest on the loans that they've received, they're actually not making as much profit or even more of a loss than they have been. So a company like this that is already running on a loss would be making an even larger loss. And unfortunately, an example like this isn't uncommon. It's very usual to see, and it's actually used by a whole bunch of companies that are in the stock market nowadays, and big companies as well, because this example that I just showed you here is Tesla. But Tesla isn't the only one. Very, very frequently used company names apply the same business model. Uber is one of them. Airbnb is another. Neither of these companies make money, which is crazy to think about. Dropbox, a service you probably use in your personal life quite a bit. For our Swiss citizens, Lime Bike. It's a service where you get to rent scooters that are outside, and you rent them for a specific amount of time or a specific distance that you cover with them. Same with bicycles. We have another service, Spotify, that we probably all are subscribed to. Loss-making company. And last but not least, which is very surprising, Snapchat. These guys all make losses, which is very, very interesting to consider that they're so prominent in the economy nowadays. Now, even though the market hasn't crashed, it might be that this is a perfect time for us to buy any of these companies because they're simply cheap and they still have a good name. But let's think about this in a bit more detail. If we think of a company that's not making a lot of profits, like any of the ones that I mentioned before, you can definitely say that all of them have a lot of potential. All of them have tremendous upside and they sound cool, and it sounds like they're going to innovate the world and be the front runners of tomorrow. Well, unfortunately, if we raise interest rates, these companies won't have as much net income, so they won't have as much money to spend on developing their business even more. Now, seeing these numbers, seeing these results, us as investors, we're less likely to invest in this company because we already have 3 red flags versus only the 1 green one. And last but not least, if investors decide that it's not a good investment, the stock price will drop, which in turn creates, again, potentially a good buying opportunity. But who wants to buy into a company that has all of these red flags, not only from a mental perspective like the stock price, but also from the actual perspective when you're looking at the numbers like the net income and the profits? Well, let's think about what Luke talked about a while ago. When you see companies like Tesla that are very influential in the stock market drop in price, it has a knock-on effect on other businesses or other commodities traded on the stock market. For example, Bitcoin has taken a huge plunge over the past 2 weeks. Now, these 2 companies or cryptocurrencies, whatever you want to call them, have impacted the entire cryptocurrency market. Last week, I talked about other companies potentially looking down rather than looking up. And let's think about, again, Luke's presentation in the very beginning of the launch of our group, what actually the process is of stock market bubble. First, you have the displacement, where a lot of people start buying things that aren't really worth as much as they seem like, for example, Tesla. Then you have the boom, where not only the initial group start buying this, but also people that don't really understand the product just start buying it because it's in the news, etc. And then you have euphoria, where people are opening up Coinbase accounts and buying Bitcoin and Dogecoin, which is a complete joke. And then in this process, the people that have invested and really understand the investment world start taking their profits. They start selling, which in turn makes the stock prices go down. However, during this time, a lot of people start thinking, well, what's happening to the stock price? What should I hold my position? What's going on? And eventually people start panic selling. Now we're in a very weird position right now where things aren't necessarily going up. They're not going down, but they're going sideways. And that could potentially be the calm before the storm. People are really waiting to see what happens over the course of the next few weeks or even months, but nothing's really clear. People aren't very sure about what's going to happen. I made my point of view very clear last week with what I think is going to happen. And over the past few weeks, we've actually seen other people saying the same stuff. I just brought you a few article headlines that you can see regularly in the financial world. People aren't secure of the market. People think that this euphoria stage is clearly hit and people aren't ready to be invested anymore because they think that things are going to go south pretty soon. Most importantly, Michael Burry, the person that saw the housing bubble pop very first, the person that The Big Short is based on, he shorted Tesla with $530 million. $500 million, he shorted them. So I don't think that I'm smarter than Michael Burry, and if he's shorting Tesla, I'm definitely not going to buy it. So considering whether or not the market has popped, well, it definitely hasn't, but considering that it hasn't popped, and it's not really moving up with a clear bounce, as we've talked about in a whole bunch of technical analysis, it should be something to consider when you're thinking about new investments. Don't get into something that you're not completely sure about. And potentially we're just in a waiting phase. Again, the calm before the storm, before things go really south and the euphoria goes the other way and we have a mass panic. Does anyone have any questions? Hi there. Thank you so much for watching our video. I hope you really enjoyed it and I hope you learned something. If you have any questions, please let us know in the comment box. And don't forget to like and subscribe so you can learn more about our channel. Thank you very much and see you next time.